Financial and estate literacy. Welcome, everyone. We're sponsored by charitable organizations. We just heard from the American Heart Association and how wonderful of an organization they are. We do not allow any for-profit sponsors for sponsorship. We only take money from charitable organizations, and we allow them to talk a little bit about their mission. What we're trying to do is present a safe environment to learn about money. And our today's presentation is about the investment world today. And Mark, why don't you come online? Good morning, Mark. Thank you for being here.
Yeah, my pleasure.
You're a true volunteer, and I'm going to talk a little bit about that in just a little bit. Mark is a background is absolutely off the wall, amazing, and why he's here today, he could be doing 101 other things that are much more pleasurable. So, but before we go into a little bit, let's go through the Ask First form. What's your educational background, Mark?
So, Pete, I have an MBA from UCI, and I have a Series 65, which I used to start my company as an investment advisor company, and I was the representative originally, and we started 25 years ago, and 2 months now, something like that. We just had our 25th anniversary.
Well, that's congratulations.
Thank you.
So give us a little background on how you got started in the investment world. You are the president and a chief financial officer for index fund advisors. But before we get there, talk a little bit about your previous life.
Now, Wes wouldn't be too happy with that. Wes is the president.
Okay.
So I am the founder and CEO. That's okay. Just want to make it clear for everybody of IFA. As I just said, I started this with just me and an assistant 25 years ago.
Well, what did you do before?
So before that, just before that, I was what's called an angel investor, and we were investing in internet startups here in Orange County through a group called the Tech Coast Angels. And then prior to that, I had a couple other companies, but my main career before this career was a nuclear pharmacist. So we had about 30 nuclear pharmacies in different cities all across the US. And we provided radioactive pharmaceuticals to the nuclear medicine department of hospitals and clinics all over the country. They're usually associated with the radiology department.
So the company got sold.
The company sold.
And you got a bunch of money.
Yep.
And then you started seeking out. You said, well, I might as well get a financial advisor. And what did you find out?
Well, so I didn't get a financial advisor, actually. And that's why I ended up in some trouble. I ended up instead with a broker at one of the big brokerage firms. And he traded a lot of stocks for me, invested me in an asset allocation that wasn't appropriate given my risk capacity. And from the time I started in 1985, I was 32 when I retired. I tell the number to people now because it's part of my story. I got about $6 million when I was 32. And probably by 1998, 99, I looked back and I realized that if I had just put that money in an S&P 500 index fund, like Warren Buffett has been telling people to do since 2013, I would have had $30 million more money than I ended up with at that point. And that motivated me to first ask around to a lot of my fellow wealthy investors, like the angel investors, to see how they had done over some extended period. And to my shock, Very few of them had done a whole lot better than I had done. And they really didn't understand the idea of why people should passively manage their portfolio as opposed to actively manage their portfolio.
So what did you do?
So I did a lot of research, and in reading some 22 books on investing, I realized that there was a firm up in Santa Monica called Dimensional Fund Advisors, and they really designed their product for institutions, but only made them available to individual clients if those clients worked with an advisor, a registered investment advisor that was approved by that company. And so I ended up setting up one of the first web-based investment advisory firms in the country, in the world, I guess, to do a couple things to educate clients about the benefits of indexing, and then provide them a risk capacity survey to identify how much risk was appropriate for them, and allow them to hire us as their investment advisor. And we started doing that in March of 1999. And we, a little bit to my surprise, we started getting 10 or 15 people a day starting to call us or email us, and they were interested in investing with us. And so today we manage 5.3 billion in assets with about 2,500 clients and about, I think it's around 8,000 different accounts.
You know, a couple of things. First of all, I love the story, and but a couple of things on that story. One is that your other very sophisticated, highly intelligent money maker friends had no clue about the consumer financial world.
That's correct.
That's just absolutely. Do you think that's still true today?
I do. I think it's a complicated world for an individual investor to figure out. And I think if people knew more about it, you would see less clients of these large brokerage firms, the Merrill Lynch's and the Morgan Stanley's and all that, just because of a number of reasons. But we're going to talk about this probably is the lack of fiduciary requirement by these brokerage firms. They're not required to act in the best interest of their customers or their clients. And that is one of the foundational differences between a registered investment advisor and a broker. And that's going to come up in my presentation.
Yeah. And that's what we're going to be my next question. Is your firm and everyone in it a fiduciary to their clients?
That's correct. The fiduciary standard is such an important concept for everybody to know about. That in particular, Pete, I hardly ever come across a client who understands, especially if they're at one of these brokerage firms, who understands that that firm does not have a fiduciary duty towards them and towards the services they're providing.
How you are a fiduciary, and we'll get into that a little bit more, explain when we get into the FINRA and the SEC. How do you charge your clients?
So one of the things I learned in doing all my research is the most fair way to charge for services in this industry is to charge it as a percentage of the client's assets.
AUM, assets
under management. Yes. And, that's important from many different perspectives. Number one, it doesn't incentivize us to sell you or convince you to buy certain products that would pay me. And I also am not rewarded for you doing more trading, calling you up and you should buy this or you should buy that. And so it takes away some of the misalignment of interests between the provider of advice and the recipient of that advice.
And so what do you
Oh,
charge a client?
so we charge a fee based on the percentage of their assets, and it's a declining fee based on the amount of assets they have with us.
And I believe it's 90 basis points where you start off.
That's our list fee at the first 500,000 of assets under management. That's correct.
And then it goes down depending on how large of an account that they have.
Yeah, yeah.
And you know,
And Pete, whether they're a friend of yours or not.
I know I always ask about whether or not I get a special discount, and I get none. uh, can you scroll to your third slide?
You want me to put it up?
Yeah, I want you to put it up, because one of the things is that I want to talk a little bit about what services do you provide besides just investment management. Go to the next slide. One more. There it is.
Yeah.
Here's a list of all the services that you provide. Are all these services available to the client for 90 basis points?
That's correct. The top ones, the second row are referrals that, we help clients identify somebody who we think could be very helpful to them as estate planning attorneys, different insurance services. We also have somebody that helps clients with health insurance, banking, checking, mortgages, some of the credit cards. These are services that are available through Charles Schwab mostly, that we can help you set up. We're almost like a concierge service for our custodians who actually hold the funds for our clients, like Charles Schwab or Fidelity.
And that was going to be my next question is that who do you custody your account through?
Yeah. Pete, should I stop answering your questions before you ask them? Yeah. So we use Charles Schwab and Fidelity. We used to use TD Ameritrade, but they were purchased by Schwab. And so we're now down to those two custodians, but they both do an excellent job for our clients.
Just give me a minute and why it's important to know who the custodian is.
Well, so maybe I could start off with a Madoff story. Mr. Madoff famously set up his own trading and custodial service. And so he could control both the statements they were getting from him, from his custody or custodian business, and from his advice side. And so that would allow somebody to manipulate things without investors knowing about it.
Yeah.
When the custodian is a different party from the advisor, such as Charles Schwab and our firm Index Fund Advisors, you receive independent reporting and reporting directly from the firm that actually holds your money. You're basically hiring us to trade on your behalf and maybe move money between accounts that have the same registration. This is really important that you appreciate that. We can't move money to just anybody. They have to have the same names on the accounts. And so it gives safety for the client to have their funds at companies like Fidelity and Charles Schwab, which are huge companies that add a lot of safety relative to those assets.
Come on back on screen, and we're gonna go through your slide presentation just a little bit. Last question, as far as the Ask First form is concerned, are you associated with anyone who sells insurance that you get a kickback from, or any kind of commission products that you receive income from? Is the 100% of the income that you receive from your clients?
That is correct, 100%. Now we do tax returns as we saw in all those services there. So that is a separate charge from our 0.9 asset fee. It starts at 0.9, depending on the amount of assets that can go down substantially. But so there are a couple of different services. Yes, we also have books that we sell and little Skelton boards and stuff. Those are just sort of educational tools, if you
Yeah.
will.
Yeah, but for
but the asset,
financial,
but we don't get paid by anybody else other than the
exactly,
client.
exactly. And if a client wanted to fire you, all they have to do is go to the custodian and say, "You're fired."
Exactly.
Yeah.
You're fired.
You're fired. Yeah, we're not going to go there.
Yeah. Officially in our business, it's called a delinking. So what happens when you hire an advisor like us, we get linked up to your account at Schwab or Fidelity so that we can act as your advisor.
Yeah.
And then if you decide that that's something you don't want, and there's no lockup period or anything, you can just let us know or let the custodian know that you like to be delinked or disassociated with that advisor.
Yeah. I want to just touch a little bit on when you started your firm 25 years ago, because we're going to talk about the investment world today.
Yeah.
Has it really changed that much? Or it changed at all?
Well, it's changed very little, is what I would say. One thing I would add to that, though, is there has been a far greater recognition of the benefits of using index funds. We estimated that when I started 25 years ago, less than 5% of the investments in mutual funds, there was only one ETF at the time, were invested in passively managed index type of products. Today, that number is close to 50%. It's over 50% now. And so that is a substantial difference, I would say, in the education and the recognition by investors that they're better to stay away from the stock picking, market timing types of investment services. So that's different. In terms of assets held at different types of firms, there also has been a substantial increase in the amount of assets at registered investment advisors like ours. I don't have any numbers handy as to what that is, but Schwab has grown substantially in its business in holding assets for registered investment advisors like us. Okay. However, still the great majority of assets are held at brokerage firms, the Morgan Stanleys and the JP Morgans and the Goldman Sachses, the Merrill Lynches of the world. Yeah. Partly because they charge much higher fees, and then they use those fees to advertise and to bring in more clients.
Yeah, and their fees are hidden. They're not upfront. But let's go to your program.
Okay, great. Let me pop that slide back up.
By the way, many of the things that we were talking about in the introducing Mark is part of the program. So we're going to kind of skip through some of the slides, but the slides are available to you online. And let's go through the, we've heard a little bit about your background. Let's go to the next slide. By the way, IFA has one of the most robust, I would say, articles, education, videos. If you ever want to, and anybody can go there to learn about stuff, right? You don't have to be an IFA member.
That's correct. There's no hidden content behind any wall. Yeah. And you know, Pete, that's a really important point. It has been my philosophy from the very beginning that the first thing we want to do is educate prospective clients and just really educate the world. And so we have invested enormously. In fact, my department that creates all this content actually has higher expenses than all of my other departments at my firm. And so we spend an enormous amount of effort, money, time, and skills on creating graphs, charts, articles, videos, as you talked about, that teach people about what we consider the proper way to invest.
Yeah.
And then once they become educated, we hope that they're wanting to hire us to help them.
Yeah. Let's go to the next slide.
Mm-hmm.
And talk about this briefly? Just
Yeah,
these issues are important not just for IFA, but whomever you hire.
that's right. So first of all, you want somebody to be your fiduciary. You want them to monitor the investments you're invested in, construct portfolios that maximize what we call your expected return. Returns are really a kind of a bell-shaped curve, so the expected is just the middle of that future probability of returns. And you want to make sure you've designed portfolios that are expected to maximize those returns given the risk taken. And we have our own tax department. We have a CPA and assistants helping him out, putting together very high level tax efficiency for our clients because we have the CPA right there in house. We have a national estate planning attorney referral service. You can search on our website, put in your state, and find attorneys in your area. We also help individual investors with their 401k choices, let alone we have about 600 million in retirement assets that we manage for, I think we're up to over 20,000 plan participants now among all those plans. And then we review your financial picture, and we can also help analyze assets that you don't have with us and help you decide whether those are good to hold or not.
Okay. Now, we already talked about
We
this
talked about those.
This is the heart, the meat of the program. What's the difference?
Okay. So we already talked about this quite a bit, but I think this is really relevant to our title of the investment world, because that world can pretty much be broken up into two different types of advice from your investment manager, if you will. They have all these terms which all get kind of muddied up, and that's why Pete's doing a real service to you to provide this education. So on the left side is what's known as the fee-only registered investment advisor. The first thing is they have a different regulatory agency who controls them, which is the SEC. And we have another slide. We're going to talk about this a little bit. But so they have different standards. They have different inspections than are that are done on the group on the right, which are registered representatives that work for broker dealers. The broker dealers are all the big names that you know out there: the Merrill Lynch's, the JP Morgan's, the Morgan Stanley's, the Goldman Sachs.
I compare it to, Mark, the real estate companies. When you go to First Team, and then you have your agents under it, and they split the fee when they sell the house. Part of it goes to the agent, part of it goes to First Team. The financial industry works very similar.
Yeah. So in our case, so first of all, we'll charge whatever fee to the client, and the way we've structured our compensation for our advisors, much like the broker that works for First Team, those investment advisors get a percentage of the fees from the clients that they advise at our firm that are part of
the
their
incentive is to grow to grow
to the assets, because so the advisor will earn more because it's a percentage if they provide the best advice to the client. And so we are literally on the same side of the table when looking at the investment world and the choices that are out there. On the broker side, things are a little different. If one of the most famous companies that provide incentives to brokers is a company called American Funds. And American Funds has these loads and trailing fees, and they have a number of ways to compensate the registered representative for recommending those products to their clients. On the left side, with a registered investment advisor, they're not allowed to collect these types of fees, commissions, trailing fees. They have funds where they get a commission up front if they buy it. Then there's another commission you can get when it's sold at the end. So all of these things encourage the representative of the brokerage firm to trade these funds, to change them and swap them out and churn investment products, because they're compensated for really the movement of these investments.
Yeah.
And that's not the case.
Yeah.
That's not the case with a registered investment advisor.
If you go to the next slide.
Yeah. 1 second. I clicked off there.
Yeah.
So here's what we were talking about with the two different agencies. The SEC is responsible for the registered investment advisors, and a group called FINRA is responsible for all the brokerage firms.
Yeah.
So,
and then look at that self-regulatory.
Yeah,
this is kind of like the fox watching the hen house. So
it is a little of that.
Yeah, who makes up the authority?
The arbitration. And the arbitration sometimes includes representatives from the industry itself. It's
crazy.
Not the best. It's not the best. Let's say that.
Yeah.
Now, I'm sure if they're going to watch this, they're going to want to argue with us about it.
Yeah, absolutely.
But come on down. We'll talk about it.
It's a lot of licenses that are given by FINRA are thought of, and the public thinks they're credentials. What do these licenses mean? And are they like a master's degree and having an MBA?
No. In fact, I can tell you, because the Series 65 is the one I took. I mean, you can go take a review course, probably, I think it was maybe 3 weeks, 4 weeks.
Yeah.
And they pretty much give you what you need to know to pass the test.
But that's why on the Ask First form, we ask, what licenses do you hold? So if somebody sees a Series 7, what does that mean?
So the Series 7 allows them primarily to collect these commissions for the sale of products. And
stocks, bonds, mutual funds, etc.
Yeah. And so those are the individuals who are generally known as stockbrokers. They like to call themselves representatives of the brokerage firms. Even we hear all kinds of names, financial managers, wealth managers, all kinds of.
Is there a rule as to what you can call yourself?
I think there are some formalized rules, but it's a real gray area, and it's been challenged by all the different entities and stakeholders.
You can pretty much call yourself anything you want.
It's pretty loosey-goosey, unfortunately. Yeah. And even if they do it formally in writing or on a website, they might verbally use other terms.
Yeah.
So what you want to focus on is that last one.
Yeah,
you want
65.
somebody who has the Series 65, who's focusing on investment advice, who is a fiduciary and is compensated usually in a fee-only basis, which means they're paid tied to your assets under management, if that's their methodology.
Okay. The last point that you have on this slide is broker check.
Yeah.
To me, every single person that I run across and they tell me they're in the financial industry, first thing I do is go to broker check and plug their name in. And so you can just go Google broker check.
Yeah,
and
here
it'll
it is.
lead you to the FINRA website.
Yeah.
And we plugged in Merrill Lynch as a firm, and wow, it has 1,475 disclosures. What is a disclosure?
So the disclosure specifies basically violations or maybe claims by clients that there were issues or problems at the firm. And then you can scroll through these I think there's almost 2,000 pages on here. So we happen
But
to be
Mark,
looking.
before we go on, I want to
Yeah,
ask you, how many disclosures does your company have?
0.
Now,
So
Merrill Lynch has 1,475.
yeah,
Uh, so is a disclosure a good thing to have?
no, it's not.
No.
You don't want it to have to disclose anything more, especially look at this one here. Merrill Lynch paid a $13,500,000 fine and sanction ordered a censure and a fine. So listen, we don't have all the details on this. I would urge you to go read up on your own if you want to
Or
dig into
plug in,
this.
what's even better, plug in the individual that if you have a professional advising you,
Right.
please look them up on BrokerCheck.
So
If
you
you're
can,
with an individual and they're with a firm like Merrill Lynch, UBS,
right, right.
Oppenheimer, you plug them in.
Pete,
And
Pete, do you still have a record in here somewhere?
I
No,
think so.
you're
I
not in
might
it.
have. I used to be a registered investment advisor.
I
Uh,
don't see you.
I don't, yeah, maybe somebody found me the other day. So,
Oh,
but
they did?
anyway, I have no idea if, yeah, there's index funds advisors.
So
And
you can, what you see here when you click us is because we're SEC and not FINRA, you have to click here and then it'll take you over to the SEC website. I guess I can click it. I don't even know what it does. So here we are.
And then everything in the financial services industry is about full disclosure. So if you
Yep.
go back up, view the latest Form ADV filed.
Right.
That tells you everything you want to know about IFA.
That's right.
Okay.
Yep. So,
It's
yep.
the legal name, how they charge.
Look, it even has our hours here.
Yeah, it has everything. So everything in the financial services industry is about full disclosure. If
Yep.
I give you all the information, you as a reasonably intelligent individual can make an intelligent decision. The problem is that it's written in legalese. Prospectuses are in 8-point type, 200 pages, very difficult sometimes to understand. So
Yep. Here I
please
am.
use BrokerCheck continuously. Let's go to the next slide.
All right. Let's get that off. And now let's go back to here. Click. Okay. So how to find a financial advisor. So we brought out, so that's a generic name, a financial advisor. And what we're trying to point out here is you should look for somebody who has a legal requirement to be a fiduciary. They have what's called a fiduciary standard. To contrast that, in the brokerage world, they use the term suitability as opposed to fiduciary. So they have a lower bar, which means they only have to recommend investments that are suitable for you, and that's kind of a loose term, I would say.
Yeah, well, it's people have such a so much confusion about this.
Yep.
If Mark recommends like 3 funds to you, one of them is American funds, one of them is Vanguard, and another one.
Dimensional. Yeah.
Yeah, he has to pick what's in your best interest. The fund that maybe doesn't pay him a commission, and
Well,
so
they don't pay us.
yeah. And
So here, no commission,
whereas a
no
broker,
fees.
it's suitable, therefore it's okay. So
Yep.
one of the question is why would one need a fiduciary? Well, there's so many conflicts of interest in the financial world. If I go on a Mercedes lot, and they call themselves a auto advisor, and I doubt whether or not the person will pick out a car for me that makes him less money.
They might send you. Do you think they'll send you over to that Tesla
Yeah,
showroom
I doubt it.
at Fashion Island?
Yeah, I doubt it. What kind of an impact do you think the AI, the artificial intelligence, is going to have on the financial world?
Well, I
It's
think
a loaded question, I
there,
know.
yeah, I think in the area of paperwork and forms and sort of mechanical things, there will probably be some efficiencies gained through artificial intelligence. But we like to say that the market itself, the 10 million buyers and sellers every day, is the super AI, almost the ultimate artificial intelligence, or ultimate intelligence. It doesn't really need to be artificial because we have all these humans involved. Because the market is collecting all of this information and opinions of known by these 10 million traders. And so we just don't see that any computer or algorithms would know better than the combined knowledge of all of these market participants.
Let's go to the next slide. Very well said, by the way.
Thank you. So how to find a financial advisor? Well, you just go to It's Your Money, I thought.
No,
No? Oh,
no,
okay.
no. I think it's important to know about similar clients.
There you go. Yeah. What kind of clients do they work with?
Yeah. How often do you meet with them? Do they charge more? How do they make their investment decisions?
Yeah. It's that form, partly what was on your form. Yep.
Yeah. What services they offer? Read the ADV form and check. Make sure you go to a broker check. Let's go to the next slide. This is another crucial issue. I mean, this tells you worlds about how you view the investment world. Mark, it's yours.
Okay, good.
If you want to take the slide off or on, it's up to you. But
I do want to leave it on for just a minute here.
Okay.
Because so far we've been just talking about, the industry and the different types of advice. Once you end up with hopefully a registered investment advisor, the next step is to ask that advisor, do you invest in an active way or in a passive way? And I like to identify the difference between these two with an acceptance of the market price of any security being the fair price, because the active investor doesn't accept that. What they're focused on is identifying securities, stocks or bonds, that are either overvalued or undervalued. And they're basically not interested in whether an investment is fairly priced or not. They don't actually buy that. They think there's always something that's over or undervalued. So the question you have to ask that advisor or ask yourself are prices correct or are they wrong? And you will hear all day long, if you turn on the TV or read anything in the financial media, that this is overvalued and you should sell it, and this is undervalued and you should buy it. The passive investor accepts the market price as the fair price. So therefore, there is no opportunity to do better than just buying and holding a very diversified portfolio of securities. And the risk of those securities is the determinant of your return. So if you own very safe bonds, you can expect a low return and a low variations of returns. They're going to vary a lot. And if you wanted to invest in small cap emerging markets, in stocks, for example, those would be very high risk and should have, and historically have had, very high returns, albeit high variability of return. And those are kind of two ends of the spectrum from a risk return perspective. And that's where people should be focused on, not trying to identify which stocks or which times are the best to be in or out of the market.
Yeah, very
Is
well
that clear?
said. Yes. You know, can we, the bottom line is that can we control the investment world? I mean, your investments. You can't really control. The market's going to do what it's going to do. So the
Well,
John Bogle, low cost, no commission, those are things you can control.
that you can control, yes. Here's what you can't control to help you out in your statement there a little bit, Pete. One thing we don't know is what the next news story will be.
Exactly.
And prices adjust constantly to this new information so that they're always fair and so that the expected return to hold those investments is basically constant over time. The expected return, okay? That's, let's say, 30 days from now, what you expect. And the way those returns are sort of regulated is through these changing prices. So if there's bad news out there, the price has to be lowered to keep your expected return, as an example, at 1% a month. And if there's good news, that doesn't mean you get to get 2% a month going forward because the price goes higher. So basically, the price is changing so the expected return stays the same. That's a tough one to wrap your head around, but that's how markets work.
I always think of passive investing as like betting on capitalism.
That's right. We have our capitalism incorporated stock certificate.
Yes.
That kind of puts a whole globally diversified portfolio on a little stock certificate. And that's a good way to think about it.
Let's go to the next slide.
Okay.
What does this mean?
Well, so I'm doing a lot of talking so far about why passive investing is a better investment philosophy. So maybe people want to actually see some data that would support that. Now, this set of pie charts includes an additional element that most investors aren't used to seeing, and that is if an investor has done well in the past, there is an additional test you can do. It's a statistical test that could indicate whether that excess return was a lucky outcome or some skill that they had to beat the market. And so basically, this is an analysis of stock picking skill among investors. And this is for a 20-year period. And when we combine all of these various asset classes, you can see we got large value, large growth, small blend, whatever. What we see here is that only about 0.3% were shown in this particular study to have what we would call a stock picking skill. And I would tell you that's well within what we call the margin of error. And that even is not the case because probably in the next 20 years, that will disappear.
You mean
and
I'm
you
not
can
going to
see-
be able to find a 0.3% person
You might,
they
yeah.
hold the secret sauce, Mark. And
So now you're going to
I
have
gotta find them.
Now you got to have double luck. You have to pick it to get lucky, to pick it, lucky enough to pick it. And the manager has to be lucky enough to pick the winners to do better than the benchmark. But let's go back to my original statement because this is evidence in support of it. What I told you is all securities are fairly priced all the time. What these managers are looking for among these 613 different mutual funds, they're looking for mispriced securities. What this tells you is there aren't any. There have not been any, let's put it that way.
It's rare.
Because of these high percentages, it's not likely that there will be in the future.
Let's go to the next slide.
I always like to compare it to the home appraisal. If you want to appraise your house, what does the appraiser do? Well, they look at 3 or 4 other properties where there was a willing buyer and a willing seller. They'll do their pluses and minuses to try to equal things out to your house. But the whole idea is if I have 3 willing buyers and 3 willing sellers, they're doing a pretty good job to establish the price of a piece of real estate, right?
Yeah. And by
what
the
goes
way,
on in the market?
yeah.
10 million traders trading 10 billion shares a day.
Yeah. And by the
So
way, even a certified appraisal is an educated guess. You never
that's right.
know what the real value is until you put it on the market.
That's true. Until we have traders. Exactly.
Yes, exactly. Let's go to the next slide.
So this is another little piece of evidence. We like to call this evidence-based investing. Okay. You'll hear a lot of talk from other people, but hopefully, as you see this information, you also will want to demand evidence. This is your hard-earned money. You're paying sometimes substantial fees. You should require large sets of data that justify the claims of whoever's making them. But this is a wonderful reminder of why it's difficult to time the market. In the previous slide, we were looking at picking stocks. These are the 2 primary strategies for the active investor: stock picking and market timing, right? So here's a 20-year period. Let's just drop $1,000 in the S&P 500 here on January 1st of 2004. And if you just held on to that, didn't do anything for this whole 20 years, your $1,000 today, or this was at the end of last year here, would be worth $6,347. Okay. So you reinvest all your dividends along the way. Now you might have a few taxes to pay, but let's say you didn't take that out of this account. That's where you would end up. This is always a mind blower to people. So if you look at good days in the market, they make up about 3% per day. And you can see here that the whole return on average was only 9.6% per year. So imagine you just miss one of those days. Now you're down to 6%. You missed 2 of those days, and now you're down to 3%. So here's what happens. If you missed 5 days out of 20 years, your return would have dropped to 7.2, and your dollar growth would have gone from 347 down to 4,000. If you miss 10 days out of 20 years, then your return drops to 5.5 and 2,000. And here at the end, 40 days over 20 years, unbelievable statistic here. You would actually end up with negative, and your original $1,000 was now only worth $791. Now, a lot of people like to say, well, how are you going to be out just on those specific days? That's not the point. If you think bad times are coming, or you think good times are coming, and you're trading in and out, you just never know when one of these days shows up while you're sitting in cash because you were nervous about the market.
You mean there's no AI algorithms that will tell me when the good days come and when the bad days are going to be here?
No. In fact, I can tell you, Pete, and the reason is all the forecasts of people are also included in this price, right?
Yeah.
So the market is already what we call looking forward in how they price these assets. So the predictions of 10 million people and all of the little bits of information and forecasts that they each have all get embedded in that price. And that, at least yet, has not been exceeded by these AI computers. I can assure you, if it was, you'd be hearing about it, because there'd be some company.
Well, it was very much of one of the first companies that had to be bailed out by the government was Capital Growth. It was started by 4 different Nobel Prize winners, and they thought that you could predict future interest rates, and they did well for about 5 years, and then they had to be bailed out by the government because they couldn't figure out credit.
Well, they couldn't. No. Capital, what is it called?
Capital Growth, or
no, that's not what it is. Maybe I can think about it. But
yeah, I can't.
What they were doing is they were also leveraging
Yeah.
their money
Yeah.
to a large degree, and that's really
Yeah.
created a lot of the
Yeah.
problems.
This
A lot
is
of market crashes, a lot of failures of investment firms are tied to the fact that they thought things were so great, they levered up and borrowed money to increase their exposure to what they think is a good investment.
so
And
so
there
one of the
shouldn't
things,
be.
yeah. Well, so one of the things that you should look for in a financial advisor is the ability to hold your hand to prevent you from making a mistake and selling out.
Yep, of trying to time the market.
Yeah.
Exactly.
Let's
Yeah,
go
and
to the
where
next
that's
slide.
most dangerous is after the market has declined,
Yeah. To sell.
you thinking that you should get out and avoid future declines. You
Yeah.
just don't know when things are going
The
to turn
better
around.
investors when they go on vacation and stop watching TV.
Well, there was a client, I think it was at Fidelity, who had passed away, and they went back and checked their account. You know, they found it many, many years later,
Yeah.
and that client had a great return.
Yeah. Yeah.
They weren't there to trade the
Nothing
account.
works. Let's go to the next slide.
All right.
Oh my gosh.
So
This.
we're just going to look at one of these here in this top left corner. This is further support for why it's so hard to pick winning stocks. So this is what we call persistence and outperformance. So if you recall back in that other slide there were 0.3% who had won. And I said, well, they're probably not going to win again in the next period. So this is evidence of that. In this case, let's just start with these 938 large cap funds. So that means investments like in the S&P 500 or the Dow. The Dow's only 30 stocks, but the S&P 500 is a better benchmark. So let's take all 938 of them, look at their 3-year performance and compare it to the S&P. Well, what we see is only 99 of the 938, or 10% of them, beat their benchmark in a 3-year period. Now, a lot of people in our industry would say, wow, let's go get one of those 99 funds and we're going to put your money in there because in that 3-year period, they showed some skill. Well, in this analysis, we are looking for persistence and outperformance. So we tracked those 99 funds to the next period. And here we see over the next 3 years, 0 of the 99 funds continued to outperform. So
Amazing.
It wouldn't do you any good to pick the winners from one period and assume they're going to win in the second period. So that's large cap, large value. We see the same thing. Small cap value, we see the same thing. The winners don't continue to win. In emerging markets, we saw the same thing. In international, we see the same thing. And in small cap funds, we see a slight 4 funds of the original 489 that continued into the next period. Certainly nothing to write home about.
Mark, you're amazing as far as your statistical data that you put together, and you really focus on the evidence. You know, one of the most popular or fee-only advisors out there is Ken Fisher.
Yeah.
And Ken Fisher Investments portrays itself to outperform the market. You've done the analysis, does he?
So I published something on Ken Fisher, and I heard from his lawyer the next morning.
Oh my gosh.
So could I pass on that one?
Sure, you can. You can.
I would just tell you that these pie charts I've shown you are very extensive, cover huge sample sizes over long periods of time.
And would
even if there
firm
were
like Ken Fisher in there,
even if there were somebody in there, I wouldn't accept that that's an indicator of future outperformance.
Okay, let's go to the next slide.
So this is a little different type of analysis. Many of you might be familiar with what's called an institutional investor. Typically, that's a pot of money, like maybe at the American Heart Association. I'm sure they have an endowment, probably as big as they are. Wouldn't surprise me if they have a couple $1 billion. And they will hire a consultant to come in and pick and choose managers to help manage those assets. And usually there's a committee involved. that the consultant makes their pitch to, and they're really hired to select and terminate investment manager firms. And that's the name of this particular paper, the selection and termination of investment management firms by what are called plan sponsors. Okay. Now, the crazy thing about this is takes a little bit of time to sort out, but I'm going to just hit you with the punchline first. And that is the managers that were fired by these manager pickers, we call them. In the subsequent period, the fired managers actually did better than the ones they hired, which can tell you this is complete randomness. So let's look at the center line here is the dividing point between the 3 years before they hired a manager or fired a manager. They go back 3 years in time. And then on the other side is what happened after they made a choice of firing or hiring a manager. So let's look at the before period. If they analyzed all the managers who were hired, what they found is that they had returns of about 3.5% above their benchmark, let's call it the S&P 500, for the 3 years before they were hired, just like the chart I just showed you. We were looking at a 3-year analysis, right? And then the managers they fired had underperformed their benchmarks for those 3 previous years. So what happened? Well, they fired these who underperformed, and they hired these who had outperformed. And of course, we all know the famous line that the SEC requires is past performance doesn't predict future performance. Well, here's your evidence. And by the way, this is 412 what we call round trip decisions where they track the fired managers and the hired managers. And so then what they found out is after firing these managers, they went on over the next 3 months to do better than the ones that they actually hired. So these who had 3.5% return in the past had basically zero return in the future. And the ones that were bad in the past of minus 0.6% per year turned out to have a little extra return. And it turns out some of this difference has to do with the fact that there are expenses of bringing on new managers and transitioning accounts. It's about 0.5%, or as you see here, just to do that. And so this is the ultimate irony that there is just millions and millions of dollars and hours and hours and hours spent by these investment consultants to do all this manager selection, and even fiduciary advisors who do this same thing, and really hardly anybody goes back to check to see what happens to the managers they fired, or even analyze what happened over the next 3 years. More than likely, they'll just say, oh, that must have been trouble there. Let's sell that, generate another commission, and let's buy another one, generate another commission.
Yeah. That's why we call ourselves the no change
There you go.
workshop. The less change you make, the better off you are. So, and that's why you want to spend the vast majority of time up front. It's a marriage that you're going to do with the company that you choose, with the financial advisor you're going to choose. That relationship, hopefully you spent the time up front and you stay with that particular strategy. We're going to go flip through some of the slides. I think most people understand a mutual fund, but what they don't understand is the expenses. Go through this.
So we talked about what we call the front end loads. These are basically a commission that's paid to the broker for convincing you to buy some certain fund. 5% is a little on the high side, but you will see them out there. You
American
can imagine
funds
with
is,
all
typically 5.75%.
Yeah, I don't know. I think that's probably in the high side. I would say more typically around 3%. I'm not sure.
Yeah, American funds is a little bit high.
They can be high, very high. That's how they exist, really, and how they get assets brought into their funds. Now I'm going to hear from them probably. Anyway, so and then they have ongoing expenses, which you could have trailing fees that pay about 0.25% every quarter or every year to the representative who recommends these investments. There's just all kinds of expenses. So these are the things you want to check very carefully.
And so on their statements, they're going to say the mutual fund is going to be listed, and right after that, it's going to tell you what class they are.
That's right. Yeah. And my understanding, there's probably 24 or
Yes.
more of these classes. They go A to Z, I believe.
Yeah, they do. But
Yeah.
a lot of
Very
popular ones
confusing.
is class C, and just want to focus a little bit on what does that mean?
Yeah. So what's this? 2%, no initial fee, but higher ongoing expenses. So those would probably be with these trailing fees,
Well,
12B1 fees, they're
Mark,
often called.
they basically indicate this is our no load fund.
Yeah.
In other words, hey, no commissions up front.
Right.
But their ongoing fees are very expensive.
The 12B1 fees they're called trailing fees. Yes.
Yes.
So you want to avoid all of that. You want to buy a fund, and this is part of the reason index funds became popular, is they had none of these upfront fees, and they had no trailing fees, and they were very low cost compared to these actively managed funds, which you see all of those fees were basically wasted given the historic data that I've just shown you.
And in IFA, what funds do you usually or mostly use?
So we primarily are using funds from Dimensional Fund Advisors. That's our favorite mutual fund company. They don't pay us a penny. They're like us. They are the most educational, rich mutual fund company, and them providing tons of information about the whole investment world, the mutual fund industry, and they do an enormous amount of seminars and educational programs for advisors like us. And this is where I learned a lot of this after I read a bunch of books. And all they did was just support the ideas that I learned and then expanded on them.
Yeah, well, I love your term, evidence-based investing.
That's what it's all about. It's like medicine.
Let's go to the next slide, because we talk about ETFs. What are they?
So you should just think about a mutual or an exchange traded fund. They're both funds as two different wrappers for a pool of securities, a diversified blend of different securities, the S&P 500, for example. So you can buy an S&P 500 mutual fund, or you can buy an exchange traded fund. And one of the primary differences is that those exchange traded funds trade like a stock. You can buy it at 9:30 in the morning, where if you buy a mutual fund, when you buy it, you get the closing price at the end of the day. That's not necessarily a benefit for you because you can't time the market. But what it did in the beginning anyway, is it allowed brokerage firms to trade a to trade an index fund as an ETF and get paid a commission. Well, fast forward, and one thing that has changed in our world, primarily because of some of the low-cost brokerage firms out there like Robinhood and a few others, and TD Ameritrade, they dropped the trading commission for ETFs and even for a lot of stocks and most of the stocks. And so it appears that trading is free, but it's not. What they did is they increased the friction, if you will. There's fees tied to, they're called fund flows, or what are the term? Flow fees. Anyway, there's some frictional costs that get paid to the firms and to the brokerage firms that do the trading. And so, believe me, there are a lot of ways that people can make money in this business when you're trading. So you want to minimize your trading, as Pete said. Yeah. So also there's some tax benefits to putting your assets in an ETF. It allows you basically to defer any capital gains until you sell the investment, as opposed to mutual funds, where as the fund recognizes capital gains, at least year end, usually it's once a year, they have to distribute those gains out to the shareholders.
Yeah. Remember that if a mutual fund does a lot of trading and they have short-term capital gains, that's their ordinary income tax rate.
Yep.
And so that could reduce your after-tax return dramatically.
We didn't even
know?
talk about taxes in any of those studies.
No, we did that in our first session,
Yeah.
but taxes are huge when
Yeah.
it comes to investing.
If we added taxes to all that investment analysis I just showed you, it all gets dramatically worse.
Let's see, we have time-wise, we have 10 minutes left. What I'd like to do is leave a little bit of time for Q&A.
Okay.
But you want to go through the IFA investment principles?
I'll do these real quick. Yeah.
Okay.
So we talked about most of these. We basically assume that markets are efficient. What that means is that prices are fair, that the free market prices fully incorporate available information, and price changes are then following what we call a random walk because they change when new information randomly shows up, and you can't predict that new information. I mean, there's a certain amount of it that's forecasted, but until it actually occurs, nobody really knows. The second thing, because prices are fair, the returns are really explained by the risk. So risk and return are inseparable, and all investment analysis should be focused on the amount of risk taken in the portfolio. And number three, the way to minimize the risk of securities is through very high level of diversification. So typically, when we design portfolios, Pete, we will have 13,000 different stocks from, 40 stock exchanges from all over the world, and it's very highly diversified. And so that's very important. The last thing, when we say structure, that's really about the various factors that explain returns, such as small companies versus large, and value companies versus growth, and high gross profit firms versus low gross profit firms. There is a structure that helps identify these securities that historically have had higher returns, and then you can design your asset allocation around those. And then the last thing is this is a complicated investment world. And I like to say you don't want to go into court and represent yourself because you'd have a fool for a client. It's kind of the same thing if you're representing yourself in this very complex investment world. There are a number of methods or strategies that could get you in a lot of trouble. And one mistake could be very costly. And I like to say you should think about the fee you pay a registered investment advisor as kind of insurance from you making mistakes or errors in your portfolio, because they're far more likely to make sure that you get a better investing experience. So this is kind of the old risk return chart. We don't have a lot of time to talk about that.
Yeah. Well,
these are the factors that I mentioned. You want me to cover these real quick, Pete?
No.
Oh, okay. That's fine.
No. The reason why is that we don't have that much time left.
Yeah.
And what I'm planning on doing is that I'm going to bring you back next season, and we're going to do. You're going to do the session on investing, on bonds and equities. But I do want you to go through this slide that you have up on the screen, because I think not only does it tell you a story about IFA, but I think it's a good lesson for all of us.
Yeah. So, I just explained to you that we think of the fees you pay an advisor as a little bit of insurance from you injuring your own portfolio returns. And so we did an internal study. This is a study of 533 clients at our own firm where we have all the data on them, right? And so what we think of as a good investor behavior at our firm is someone that captures the return of the portfolio we put them in. So let's say we start you out in a 60-40 portfolio, right? And what we looked at here is 209 clients who actually did what we told them to do. They bought, they held, they rebalanced their portfolio. And in that case, and this little extra is probably because they have a little lower fee than our 0.9 fee, but those clients who followed our advice actually captured the return of the 60-40 portfolio. But let's skip the middle one that's a little complicated. Here's the group that did not follow our advice, sort of client-led investment decision. In 2008, they got nervous. They called us up and said, Mark, get me out of this. Aren't you watching the news? And I said, yeah, but the news is already in the price. Why would you sell? We don't care. Get us out. So we tracked those 161 clients who didn't follow our advice. And what we discovered is they only captured about 78% of the return of their original portfolio that we put them in. And that could cost them a lot of money, depending on how many dollars they have invested in that portfolio.
Yeah, it's pretty amazing. Dunbar does a study every year.
Delbar,
Yeah, and
same thing.
They show that individuals, the average investor, does so poorly than the index funds.
That's right. Or just the index in general. They compare it to the S&P. I have those in my book and my film.
By the way, you do have a book.
I do. I didn't know that. Yeah.
Okay.
How can
they get a free copy, Mark? I'm using the word free.
Yeah. Listen, Neil will be happy to get him a copy of my book if anybody's interested in a book. If you sat through this whole lecture, you deserve a book. But
how would they get the book?
So just, you've got Neil's email there. What I would suggest is you have them email Neil. It's just
Neil at
IFA.com. And
they want the book.
They can pick up the book. Here's a little promo on our website here for the book. We also have little videos that explain each of our 12 steps for the recovery program for active investors. The first one is all 12 of them rolled together. And you can just see, Pete, I'd never done this before. We submitted it to a whole bunch of book contests and we won first place in 4 of these 5. And we won second place and another one. And so it's kind of nice to get recognition. That's because I hired it on the back. I hired an independent publisher this time to do my 20th anniversary 10th edition of this book. I can't believe I wrote the original 20 years ago. And then every couple of years.
Did you have to make a ton of changes?
We do, because
in 20 years?
Yeah, because of all the data. The book is very rich. Okay.
But the principles are the same.
Yeah. So we mostly about the data. But actually, to your point, for 20 years, the overall structure that we discuss in the book has remained constant. Exactly. And all we're doing is just updating the information, which continues to validate what we said 20 years ago in the book.
Come on, screen.
Okay.
There's a question about, what do you think about an investor that's both a broker and an investment advisor? In other words, a hybrid registration. I can give you my opinion, but
that's not the best idea. I've heard of firms that do this. It allows them to take these commissions and trailing fees on one side, and on the other side, give this impression that they don't do that and that they're a total fiduciary. It basically allows them to be a non-fiduciary and a fiduciary all in the same place.
Yeah, and you never know what hat they wear when.
Yeah, exactly.
It's a magician's hat.
Yeah. I wouldn't recommend that.
Don't recommend it either. How about the difference between a fee only and somebody who says I'm fee based?
I'm not sure. What I would do there is I'd ask them for their ADV, where it has to clearly spell out how those fees are charged.
Yeah, it's very similar to the hybrid.
Yeah, it might be. Sometimes you'll hear a fee base. Maybe they charge by the hour or they charge by a flat dollar amount. But I like to say the percentage is in the best interest of the client because it incentivizes the advisor more to want to work with you so that you do better, because they do better when you do better.
Yeah, someone still doesn't really fully understand the term fiduciary in the financial world.
Yep.
Could you take another stab at it?
Well, here's my favorite way to say it, that a fiduciary is required to do what's in your best interest, even if it goes against their interest. I love that last part. You're required to do what's in the best interest, even if it doesn't help you or in it that provides you more income. And I can tell you, I've been through several inspections with the SEC, and that is one of the key things they're looking for. Did you do something that was not in the best interest of a client? And that's what they will call you out, fine you, provide discipline action around those types of issues.
Yeah. The other thing too is that in the brokerage world, the average client pays approximately 3% per year.
Yeah.
The problem is it's so difficult to find. Do you on a quarterly basis tell your clients what you've charged them for the previous quarter?
So we bill clients and they get an invoice for every quarter.
And why is that not the same in the brokerage world?
Well, because you're taking it out each time you do a transaction, and it comes out just a little bits at a time.
And you don't see it.
And there's no recording of the total. Yeah. For us, you will have 4 invoices. It'll be very clear what you spent for the entire year. And it's the same thing with returns, by the way. The accounting of returns at brokerage firms are very difficult. And at most, you'll get 1-year return. You can sometimes request lifetime or inception to date returns, but they're very difficult to come by.
Yeah. This concludes our session for the investment world. We have not discussed insurance, but insurance has its own fees, expenses. They're enormous.
Complications.
I
think that's even the most important aspect of this, because you don't really understand what you're buying.
Yeah. So one of the things that we're going to do right now is we're going to end this particular session. For the attendees that are live with us, we're going to conclude, but we'll allow for some additional questions that you want to ask. Next week, we have
equity and fixed income investing with our guest speaker,
Fouad.
Mark Wilson.
Okay, we'll do that next week. And thank you for joining us. And this video will likely be on the website
within
a week. All right.
Pete, I just want to thank you on behalf of all of the participants that come here for helping them learn more about their money and about their estate. You're doing a wonderful service for these investors, and I hope they appreciate what you do for them.
Okay. Don't go away, Mark.
All right.
I'd like to say for our live audience, stay with us for a second. Mark, thank you very much for the presentation. You are a wealth of knowledge. This is an amazing reminder that I should never, ever try to pick stocks again. I've done it. It was a fiasco. Having been with financial and estate literacy.
Fouad, it sounds like you need a little help. If you need some advice, come see me.
Yeah.
I think we might have struck a nerve with that 12-step recovery program.
Yeah, no, I've learned my lesson. I've learned so much with financial and estate literacy that now I have a concrete plan and I know how to be patient. ETF, awesome. S&P 500 all the way.
Awesome.
Thank you, Pete, for making this program happen. Thank you for being the moderator. Like I said, our live audience, please stay with us. But for the audience watching the replay, thank you for watching all the way to the end, and we'll see you in the next class. Thank you.